Good morning. This is Rob McDougall from Zhang Financial with your weekly economic update. Today is Monday, March 27th, 2023. So last week, the biggest news, of course, was the environment for U.S. banks and U.S. banking stocks. On Wednesday last week, we did a webinar and did kind of a deep dive on Silicon Valley Bank and four of the other banks that had failed in the last couple of weeks. So if you were not able to attend that webinar and would like to and don't have the information, please let your client service manager know. They can send you the login materials as well as the accompanying charts. So last week was relatively quiet in terms of news on the U.S. banking environments. There were no further failures, no FDIC takeovers, no consolidations. The one big issue topic that keeps coming up that may be legislated is the amount of deposit insurance. So currently FDIC, $250,000 per account, and the Treasury Department has already noted that they would honor deposits above that for Silicon Valley Bank and Signature Bank, and probably not for First Republic. So the question is, at what level will they support banks, smaller regional banks? Will they cover all those deposits or not? That is something, again, that is being talked about politically and probably some resolution in the next few weeks. We'll keep you updated. Last week, in terms of economic activity, very light calendar. There were two housing-related metrics that came out. I would say they were mixed at net, but the big news last week being the FOMC meeting, which occurred on Wednesday, or at least the release, so we'll talk about that a little bit. So the two metrics last week that came out, again, mixed housing on Tuesday, existing home sales. Now, existing home sales came in much stronger than expected. So if you look at the chart, it's been down for the last 9 months very severely. The expectation was existing home sales would come in for the month of February at 4.16 million. Actually came in at 4.58. So that's good. We're starting to see some turnaround in the housing market, which has been the hardest hit sector from the Federal Reserve rate increases of it last year. The second housing-related metric that was later in the week, it was on Thursday, new home sales. Slightly disappointing. The expectation was 650,000 new home sales, came in at 640. So net, a little bit mixed on the housing side. But the big number last week, or the big event, was the FOMC rate decision, which came on Wednesday. So the expectation had been built into the Fed funds future market, 84% probability that we'd see a 25 basis point increase. It's exactly what we got. So the new target for the Federal Reserve going forward is 4.75 to 5.0. The press conference after the release was interesting in that Chairman Powell appeared to be attempting to balance the need to continue increasing rates, to squeeze out inflation, to get inflation down to the Fed's target of 2.0% on the PCE, which, by the way, we'll talk about in a moment because we have the February number coming out on Friday. But they need to really balance rising interest rates, increasing interest rates with what happened in the banking environment, because a big issue, as we talked about Wednesday, was actually the bank's holdings of U.S. Treasuries and mortgage-backed securities. So by pushing up the Fed funds rate over the last year, an unexpected consequence of that was to deteriorate or weaken the balance sheets of the U.S. banks. And then when depositors took out deposits in an aggressive fashion in banks where they had more than the 250,000 FDIC insured amount, it collapsed a couple of banks. So Powell mentioned that they are cognizant of that, but he also pointed out, and this is the most important thing I think from Wednesday's discussion, he does not expect any Fed cuts through the end of the year. So we're going to see about that because the market definitely strongly disagrees with that. So expectations now for the next Fed meeting, May 3rd, is that there is a 13% probability of a 25 basis point increase. No expectation of anything above that. So therefore, 87% probability built into the Fed funds future market that the Fed will not hike during the May 3rd meeting. What gets much more interesting is when you look at the end of the year, because again, the Fed just set the range at 4.75 to 5.0 and said they won't cut this year. The Fed funds future market completely disregarding that. The Fed fund futures currently are pricing in a 99.9% probability that rates are going to be lower at the end of the year than they are today. So we'll put it in the slides. You can take a look at the distribution of it, but almost a certainty in terms of the market perception that Powell is not correct and that the Fed ultimately is going to have to lower rates later this year. GDP expectations for the first quarter, we always look at the Atlanta Federal Reserve. There was no change there. So again, the economy looks pretty strong at this point. Expectations are still for a 3.2% GDP positive result that will be reported next month. Inflation expectations rose just slightly last week. These are at really low levels. If you look at the chart over the last couple of years, we're down at very low levels of inflation or expected inflation. So the embedded inflation expectation currently in the 10-year break-even market is 2.19% inflation average over the next 10 years, up slightly from last week, 9 basis points. Last thing I'll mention in terms of last week, we'll go over the market returns. Obviously, the market has been faltering, moving back and forth. It might be surprising to find equities are actually up on a year-to-date basis. We'll look at that in just a moment. But we like to look at occasionally the AAII Investor Sentiment Index. That is the American Association of Individual Investors. And take a look at, on average, how investors are feeling about the market, because historically, the investor feeling, small investor, has been instructive if you're a contrarian. So when individual investors get very bearish on stocks, it's a great time to buy, usually. So anytime the AAII has been under 20% bullish since 1987, the next 12 months, the S&P has returned on average 18%. 2 weeks ago, we hit under 20% again. It came in at 19.2%. Last week at 20.9%. So again, if you're a contrarian and you're betting against the small investor, it looks pretty good for stocks just using this metric over the next 12 months. So last week, in terms of returns, bank stocks stabilized. It's a good thing, up a little bit, 0.65%, but the regional bank stock index year to date has been horrific, down 17.93%. So for the U.S. markets last week, S&P 500 up 1.41%, driven completely by large growth, which is a reversal from last year. So last year, value outperformed growth by 36%, maybe a little bit more than that. Year to date now, growth has outperformed value by 14%. So it's value's given up a little bit relative to growth year to date. International markets last week, very much lockstep with the U.S., and it actually has been on a year-to-date basis. So last week, the MSCI ex-World ex-U.S. was in line with the S&P at roughly positive 1.4%. And last week, we also, on the fixed income side, had a small positive bond rally. The aggregate bond index that we always track was up 0.5%. So in terms of economic news coming up this week, we have the consumer confidence number coming out tomorrow. That's the Fed's version at the University of Michigan. The expectation is we're going to be down for the third month in a row, expected to come in at 101.5. The prior week or prior month was 102.9. Friday is when we get much more economic activity. We have 4 very important indicators that come out. all four of these last month, the month of January, were elevated. And the expectations are they will all come back down to lower levels. We have personal income, personal spending, and PCE, which is an inflation indicator, the primary one that the Federal Reserve uses for policy setting. So personal income for February, the month of January, was a positive 0.6% month over month. That's expected to decrease down to a positive 0.3%. Likewise, personal spending was really strong in January and surprisingly strong. It was up a positive 1.8% month over month. That is expected to drop down also to a positive 0.3%. And the more important ones, I think, for the markets this week, PCE and PCE core, both again were elevated in January. Both came in at 0.6. PCE is expected to come in at 0.4, as is PCE core. So that's it for the recap of last week and what we have coming up this next week. We thank you very much for attending and look forward to seeing you next week. Thank you.